But do you have any questions or anything else you want to say before we get into the chit chat?
I'm good to go.
Lead the way.
Okay. Well, welcome to what I believe is already the sixth podcast that IFI Global and its publication AIS has done with AI Raise in our series on alternative investment strategies. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London. AIS, or Alternative Investment Strategies, is one of our 3 monthly publications. We also have a Global Macro Weekly as well. And we are now doing that as a JV with AI Raise. And as part of that, we have been doing a series focusing on the different private markets and alternative investment strategies. And today we are looking at real estate investing. And I was just thinking in preparation for this discussion today that there's been really a substantial amount of headwinds that the real estate sector, or sectors in plural, because there's so many different parts of it, have faced over the last few years, going from the COVID pandemic through to the more recent and quite aggressive raise in interest rates in different parts of the world. And nonetheless, in big chunks of the real estate sector, performance has been really surprisingly good, probably better than people would have imagined if you guess what was coming at it over the last 3 or 4 or 5 years. In that sense, it's really been remarkable. So today we are going to look at the areas that should continue to do well, hopefully will do well, and also perhaps touch on what the dangers and pitfalls could be in this sector over the coming years. And I'm absolutely delighted that we have with us today Zach Winner and also Maxim Sholknik. Am I pronouncing your last name correctly? Probably not.
Probably not. Just let's skip it. Just Maxim.
Okay, just
Maxim.
do. Thank you very much. Well, I should have asked you that before we got going. And Zach is the founding partner and CEO of Prosperity CRE, a PE firm providing investment opportunities in apartment complexes, and he joins us from California today. And Maxim is general partner of Focus Estate Fund, which he co-founded in 2015. He has over 20 years experience in real estate investing, and he joins us from Lisbon. And as ever, we have Lavin Chandra, the CEO of AI Raise, who's in the slightly less glamorous place of London, I imagine, today. Not far from where I am, but
it's Mayfair. It's Mayfair, Simon. It's very glamorous here.
Mayfair. All right, Mayfair. Yeah. Fantastic. Anyway, welcome everybody. And just for the record, we are recording this as a podcast on the afternoon UK time of May the 27th. So if there's some dramatic event that happens in the next few days or weeks, forgive us for that, because we didn't necessarily know what it was. But if that, hopefully many people will be watching this or listening to this podcast in the weeks and months, perhaps even years ahead, who knows. So welcome to you all. I think the best place to start is just to ask our guests today if they'd like to perhaps a little bit expand upon my very brief introduction of them. Zach, would you like to say anything more in addition before we get into the Q&A?
Sure, I'm happy to, Simon, and thank you, Simon and Lavin, for having me on the podcast. I'm really looking forward to it. Our firm, Prosperity CRE, we're really a boutique investment firm, and our primary focus is on our client satisfaction and experience. And we're curating investment opportunities in large apartment complexes, primarily in the Midwest and the Southeast. And our investments are designed to deliver both consistent, ongoing cash flow and building long-term wealth. And we can get into some of the specifics over the course of our discussion.
Okay, thank you. And Maxim, same to you.
Yeah, thank you so much. And as Zach just mentioned, really appreciate you guys having me here. So I manage a private equity real estate fund based in Luxembourg. We focus exclusively on retail. Out of something like 400 trillion of real estate assets worldwide, we decided to focus on a very narrow niche, which is value-added, mid-sized, non-prime convenience retail. What that means, we can go into details a little bit later, but that's the focus that we keep. We scale geographically. We work in European Union and in the UK. And, our philosophy is, the main person in this business is the customer that goes to the retail centers. And so if the customer is happy, then the tenants are happy and paying well. If they are happy and paying well, our limited partners are happy and paying well. And then if that happens, if our limited partners are happy, we are happy as a fund managers. So we are in a sense in a happiness business, and with the customer in the center of it.
That's it's the first time I've heard anyone describe being in the real estate investing business as being in the happiness business, but it's probably a very good way of putting it. So maybe I'll ask the first question, and I think Lavin's going to progressively take over on that. How do your operations, do you think, deliver stability and constant returns in secondary markets for LPs?
Well, just to comment on that, I think, we are in the secondary markets. We're in the Midwest and Southeast of the United States. And we're very, very selective in the properties that we invest in. They need to meet a number of criteria, ranging from being in the right market down to the right neighborhood. They need to be of a certain vintage, and the apartment complexes need to have a minimum unit count and have the right unit mix. And they also need to have a certain high caliber tenant base that we're targeting. We're also only investing in properties that are cash flowing from day one. They're stabilized properties, but they're also undervalued, and the current owners aren't maximizing the cash flow potential. So before taking over ownership, we develop various strategies to increase that net operating income that the property is generating. And then as soon as we take over ownership, we begin implementing those value add strategies. So our investors are not only receiving cash flow from day one, but they're also seeing that cash flow increase over the holding period. And the increase in annual NOI is also significantly increasing the value of the property, so that when we ultimately exit, our investors are also receiving very strong profits on sale.
Maxim, do you want to have a go at that?
Yeah. So I think what Zach said makes a lot of sense, and that's exactly our view of building that business. I think there are three main pillars that the consistent returns are based on. So the first one is the strategy, or let's call it investment philosophy. The second one is the team, because your philosophy or investment strategy is only as good as your team is. And the third pillar is the technology stack, which was, 10 years ago, the technology stack in real estate was not really that important, probably. I'm a technology guy in a sense. Like part of my life I spent in IT and product development. And so, again, 10 years ago, if we're talking about, let's say, security of real estate, you hired security guards and that was it. Now you can get Gemini AI, look at the cameras, and do the behavioral tracking and save a lot of money at the end of the day if your portfolio is big enough. So the technology is becoming more and more important with each year, especially with the with this surge in AI, which is basically, similar. I'm that old that I remember still what the internet did to businesses. And so now I think we're catching the same kind of wave. So there are almost limitless opportunities with which you can do with these new technologies and how they intersect. But getting back to the team, I think our team has almost 60 folks at this point. This is untypical for a fund of our size. We are a 140 million euro of assets under management in 12 shopping centers across Europe and UK. And so people who work in the company, they're not property managers or facility managers. They focus exclusively on traditional fund elements such as finance and debt and acquisitions, but we have like half of the team doing on-site things such as asset management, marketing, and project management. And the philosophy, like every fund manager thinks he's a brilliant in a way. They think that they have some kind of special sauce. They're alpha, if you wish. And we do think that we, have this narrow niche, not just because we've read some books or, had some brainstorming exercises, but because the life taught us different lessons. And for some of them, we paid dearly. And so that narrowed our focus to this rehab for shopping centers that I mentioned, the value-added mid-sized non-prime convenience retail. And basically, our strategy has survived the COVID. I mean, you've probably heard during the COVID times that the retail was not as sexy as it was. So that did not relate to the convenience retail, which basically even increased in value throughout COVID. And basically, we tested lots of models during those times. And after COVID, we decided to scale drastically. So that's it for now, because I can talk about that for days, if not months. So you have to stop me at a certain point. But I'll leave this question answered if you don't have any follow-ups.
I have some follow-ups on this one, Maxim. Thank you for bringing in the technology aspect into this one. I wrote a book about PropTech in 2018, where the word PropTech was kind of like new. I just recently wrote a book about AI in real estate. So lots of new information, and I hope your team is going to read it. But let's focus a little bit more into the operations for you, Zach, and also for you, Maxim. So an opportunistic investor or a value-add investor has to have really strong operation.
Yes.
Where are you implementing technology? How are you doing it different? Where you are in a position that you can basically buy a property in the middle of nowhere and still make it run and deliver really good returns for the LPs.
So for us, in identifying the properties, we are incorporating technology to narrow down both specific markets and specific sub-markets. We look at, I'd say, over 27 different metrics, and we're increasingly using AI tools to help us look at these various demographic and market components. And then, once we acquire the properties, we are using various technologies both to help market for potential investors and to help vet those investors. There are new programs available, third-party programs that we're using to help ensure that we're getting qualified tenants in place. And then from the tenant standpoint, there's been a lot of research out there that shows tenants, for example, would rather have a high-tech package than a pool at their complex. So they're, especially with millennials, Gen Z, they really want the technology. They want, for example, smart homes in their units. They want full internet Wi-Fi capabilities. And so, I think across the spectrum, we're seeing technology being incorporated, both in how we select the properties, how we operate the properties, and then for our tenant experience.
So Zach, you basically utilize a lot of technology at the beginning of the cycle, where you are selecting the right property, which is sometimes even below market value and sometimes even off market. You, on the other hand, Maxim, you have a strong operational team, which is optimizing the properties on a day-to-day basis. Is that correct?
Yeah, but before I answer your question, I'd like to denounce a statement and then verify a statement. So
go for it.
So on the book side that you wrote, so about the PropTech from 2018, that's probably old news by now. But regarding AI in real estate, you have to share that link. If it's not contradictory to the policies of this podcast, I would be happy if you could post, a link in the comments somewhere. That would be great. I'm sure I'm going to read that. Then on the denouncing side, so you mentioned that we are acquiring properties in the middle of nowhere, and that's not how we see it, obviously. So we don't acquire assets in the prime locations. In that sense, maybe yes, but then we're going for secondary and third tier cities where we have strong communities, because again, real estate, especially value added real estate, is kind of a negative selection business. And we have lots of different red flags. And one of them is the social demographic part of it. And so if there is no strong local community and strong local economy, then we simply would pass on the opportunity. So we don't consider those, locations to be in the middle of nowhere. It's rather, a strong island of strength and resilience and social interaction, et cetera, et cetera. And what we try to do is kind of strengthen it. But then you're right. I mean, it's a challenge when you acquire assets in a third tier city. You don't have any staff there typically, because you're either located in a capital or in big cities, or sometimes even outside of the country. Some funds operate from the outside, which we are not, but still this is the case in many other with many other funds. So in our case, it's a combination, obviously, of in-house and outsource. And so like we try to outsource facility management and property management. Like in Poland, we work with BNP Real Estate, with White Star, with Cream. In UK, we currently work with Savills and GLL. But then on top of that, we build a layer of different teams. Each of those teams is responsible for different elements, again, such as asset management, marketing. Like just in marketing, we have 7 people working in the fund, but they do not market the fund. They only market the assets. If you've ever had anything to do with a shopping center, or let's say real estate marketing, it's usually a very lousy marketing. I call it a copy-paste marketing. It's like a Me Too marketing. And what we typically do is we get our team to work on the events, digital strategies, et cetera, et cetera. And again, it's always a combination, but I'm a big believer in you getting hands-on in value-added assets, because if you are not, if in value-added or opportunistic, you rely solely on outsourcing, that rarely works. So we have lots of control and expertise, and things we learn every day, because one can say, look, I've been to that shopping center. I know all about shopping centers by now, but this is not the case. So with each shopping center acquisition, we learn something new, and those new best practices we spread across the portfolio by having our in-house team kind of manage that experience into unlocking the value-added components and increasing the net operating income at the end of the day.
That's very fascinating. And yeah, happy to share the book. It's not out yet, but happy to share it directly with you if my publisher is allowing me to do so. Let's go a little bit deeper into the returns in AI. What do you think where the LPs should allocate their capital right now within real estate? And thinking about AI, how do you predict the price of those properties to appreciate or depreciate? Zach, you mentioned you have 26 data points before you make a decision.
Yeah.
There are probably even more data points which we can utilize nowadays with the new technology.
Yeah, I think that's right. So we continue to look at all of our data points, and then we're also on the constantly monitoring to see what other tools we can incorporate through AI to further refine our research and identifying, markets that we think are the best markets for value add multifamily. But in terms of where LP should be allocating their money in the U.S., I think right now large multifamily in the U.S. is particularly good. In the Midwest and the Southeast, it's particularly compelling for global LPs. So why is that? I think first, the fundamentals, they're incredibly strong. The US is facing a chronic housing shortage. It's estimated that the US needs over 7 million additional housing units just to meet current demand. And demand for rental units is outpacing supply, especially in regions where the population growth is surging. And that's something that we are constantly looking at. We're looking to target markets where we're seeing population growth, job growth, net migration in. And this is an area where I think we can further target and micro-target using AI tools to identify specific submarkets in those areas where we're seeing net migration in and job growth coming in. To a large extent right now, what we're doing is the data has like a time lag, like a 1 year time lag. And then we're also monitoring where large employers are coming in, for example, and building out new projects, multi-billion dollar projects. But as AI, I think that's an area where probably in the future, we'll be able to further refine that and get more real-time data. But the
What,
second, well, go ahead.
what kind of data do you have, do you like to use at the moment? What kind of data do you wish to use in the future, which should be then hopefully available?
So right now we're using a lot of data that's provided by the government in terms of population growth and net migration in. We're using third-party services that provide information on that. We're looking at demographics for the area. We like to target diverse economies that have at least one major STEM component, so that we're getting a good mix of both blue collar and white collar job growth. And we also look at crime statistics, and oftentimes on the crime statistics, we're having to go down to the local, law enforcement level and look at their data. So that's an area as well where, I think AI aggregators will be able to provide more accurate and consolidated information.
Dan, can I ask you,
Yeah.
this data you're talking about, does it have any, and the population growth or the demand for extra property, is there any particular characteristics about it? Is it the younger generation post-college that you're looking at? Is it from different, is it from immigrant groups? Where is it coming from? And related to that question is, one of the big things about the Trump administration, obviously, is the stamping out of all the illegal immigrants. And
Yep.
will that have an effect upon some of what you've just been talking about?
Yeah, great question. So it really is property specific. So I'll give you two examples. Our latest acquisition was in Evansville, Indiana. And those who aren't familiar with Evansville, Evansville is the third largest city in Indiana. And it's got a very, very large healthcare component and a very large education component. And we purchased a 159 unit Class A 2020 build property from the developer last year. That property, the median income level for the tenants is $159,000. That's a very, very high median income level for apartment
Particularly in the
owners.
Midwest, like in Indiana.
Particularly in the Midwest. So why is it so high? It's located in the downtown submarket, which is the best submarket for Indiana. It has the highest population growth, job growth. It's where all the most of the employers are. It's also where most of the shops and restaurants and entertainment venues are located. And so for that particular property, the tenants are typically they're either medical residents working and going to school at a medical district that's in walking distance to Post House. And we also have a lot of C-suite office executives. Evansville does a very, very good job of attracting corporations to locate their headquarters there. Skanska has a corporate office there. Um, a major plastics manufacturer has a corporate office there. There's lots of financial institutions that have offices there. So we have a lot of higher income people there. It's Class A. Because of the high income, it's not going to be impacted by the new immigration policies. The new immigration policies are going to affect more C plus working class apartment complexes, where you might have a higher proportion of tenants who are in that kind of bracket where they may be immigrants and not documented. So it's not going to really impact that type of a tenant base. Another example is a property where we're in the midst of acquiring, and that caters more towards millennials, single, young professionals. And it's in a downtown area of Kansas City, another great market for multifamily. And so again, it's more of a that one I say is I think of as a Class B plus, Class A minus property. It's a beautiful renovated 1920 built hotel that got rehabbed down to the studs in 2020, and we're buying it directly from the group that redeveloped it. But again, it's a very high caliber tenant base. The income level probably isn't as high as this other one in Evansville, but because it's catering more towards young, newer professionals. But again, it's not the type of property that's going to be impacted by the new immigration policies.
Yeah, that's fascinating. Thank you for that, Zach. I have a question for you, Maxime. So what I've seen in the past very often, if there's a crisis, a lot of the limited partner investors are deploying their capital in tangible assets, such as real estate. Now we are in a situation where investors are very hesitant, not only in the US with the change of the government, but also in Europe. Why do you think there's a lot of dry powder? And why do you think that real estate funds are currently sitting on billions and are not proactively going out and deploying capital?
Well, if I may jump a little bit on the previous question before returning to this one.
Sure.
Yeah, I think like in every, like, I have a conflict of interest, obviously, answering in a way that, only retail is the king or something like that. Obviously, it's not true. So in real estate, you have great niches in every sector. And it's a matter of the right team to untap the potential of that niche. I wouldn't go as far to suggest that West Side is better than the East Side. It's, the residential is great. It has great niches, and I'm sure what Zach was saying. I mean, they've tapped into a very, very interesting source of revenue, very stable, and I'm sure that the data points they're using are quite risk averse, etc. But there are niches in every sector. I'm sure there are niches in offices and logistics and retail. I think the key there is the word diversification. So there is no, if you remember that movie Highlander, where the only one could stay at the end of the day. So it's not the case with real estate investing. You have to diversify. You have to work with teams that can make sure you're not losing money, because working with real estate, but I'm not talking about opportunistic strategies. I mean, maybe there losing money is okay, but when it comes to core plus, and value added, I mean, the first thing probably every fund thinks of is we cannot lose a dime, and only then what's our returns going to be, right? Okay, then on the AI side, I mean, AI has given a huge leverage almost in every field right now. So what I loved about COVID, I mean, this is a strange conversation because usually people say what they hate about COVID, but what I loved about COVID is that it gave a lot of time to reflect. because everybody was staying home. Everybody suddenly received much more time to think about stuff. And we were doing lots of refactoring of our operational processes within the fund. And so one of the things we've done post-COVID is that, prior to COVID, we moved more, emotional about acquisition and M&A pipeline. Not emotional, no, I'm sorry. More like passion-driven. That would be a more correct way to define it. But then we thought, okay, we have lots of different criterias that we kind of use from the top of our heads. So let's define a scoring matrix of sorts that basically let's digitalize ourselves. And what we did is create the scoring matrix. It has something like 80 different parameters. And what we are right now doing is we've just like a couple of weeks ago, during some AI tests, we verified that we're able to have AI score assets based on our scoring matrix, based on unstructured data that we can fit it with, such as financial package and presentations. And so, previously, if we had to spend, a week, 2 or 3 analyzing the asset to get all the data points, in the system, now it's a matter of 10 minutes. If you have the right scoring matrix and the right tools, you can analyze things in 10 minutes. So the pace is kind of increasing even further, and AI is helping there. I heard a brilliant quote, I think, several weeks ago. AI is not taking jobs. It's people who know how to wield AI are taking jobs from people who don't know how to wield AI. And so I think that's where it's headed. Okay, but getting to your points, it's a little bit alien to us to store capital in our fund accounts. So I cannot tell you anything about how high net worth individuals think, or family offices think, or institutionals think. I think they should answer for themselves why they, keep dry powder where they are and how they do it. But in our case, we don't. So the way how we structure the fund is that we are a closed-ended fund, and we make capital calls only during allocation periods. So let's say if we are acquiring an asset, a shopping center, then we make a capital call, and once it is there, we use it to acquire the asset. Or let's say we're doing a reconstruction or redevelopment, and so we make a dedicated capital call just for that particular reason. Being a closed-ended fund, we don't have the legal requirements to reserve part of the equity to make redemptions, and so that's why we are able to allocate the entirety of the funds to increase the returns at the end of the day. So we are not thinking in the category of what are we going to do with the reserves. As the way how we form the fund, it operates in a way that we shouldn't have any reserves outside of the operational reserves. So no equity reserves are held within the fund. But again, at the end of the day, that what allows us to reach that level of returns that we're having, because we're optimizing each and every element of the fund, including this one, to reach the highest possible returns with adequate risks.
I
Maxim,
agree.
Can I ask you? Sorry, can I ask you?
You go ahead.
Who are the typical investors in your fund, and also the same question to you, Zach.
Yeah, so right now we have almost all of them are high net worth individuals, and we have one family office at this point, but we're working towards, with the help of Lawin, to get more family office exposure.
Yeah, and it would be the same for us. We have primarily high net worth individuals, and we have a couple of family offices that have invested with us, and we have a couple more that are now looking at our deals. So
But why do you think?
So for us, it's a natural growth progression. We started out solely with smaller retail investors, and then over time we've been seeing a progression as our track record grows and grows of of larger investors from high net worth individuals, and now we're starting to see larger investments from financial firms and family offices.
Okay, before we get on to other areas and related to that, we're doing quite a lot of work at the moment on tokenization of real assets and tokenization in the private market area. And you guys, I'm sure, both know that in terms of its development in the private market area, real estate is probably, or is significantly the largest, not necessarily all in fund structures, but some in fund structures as well. Do you guys, are you flirting with tokenization at all to get more investors or not?
Oh yeah, but just flirting. No other moves. So we're not on the other stage. So we're not, asking the lady to go with us yet. We're still in the flirting stage. But then
you haven't even invited her to dinner yet. Is that what you're saying?
Yeah, we're still considering it.
All right.
So you can use tokenization for two things, really. You can try to invest from the assets, effectively sell the assets, or you can attract limited partners with the help of tokenization. And so the problem there is there are three types of expertise you need to tackle to do that. So first expertise is the technological expertise, and that is in abundance right now in the market. So the second one is the legal expertise, because when you have the code, you need to make sure it's compliant with all those different norms and regulations. You simply cannot use smart contracts because, real estate is local, investors are local, compliance regulations are local. So it's a little bit much more complex than that. But there are lots of different teams who tackle the legal problems nowadays. And the third, very important, I think the most important expertise is marketing. So it's not, I very often meet people, especially startups, that are thinking in a way, okay, we're going to do this, we're going to code this beautiful product, and people just flock in line trying to buy it or use it, whatever. It doesn't work that way. So besides having a technological and legal stack, you need to invest into your marketing efforts hugely and attract those customers, whether the potential buyers of your real estate or potential investors. And so that's the hardest part, because that's a very deep expertise you need to master there, and it costs a lot. And right now, I didn't see a single product out there in the market that has all those expertise under one roof and provides, a meaningful success fee-based model of cooperation. Because most of the proposals you see right now in the market is that, okay, you pay us 100 or 150 or 200K euro, and we're going to arrange all that for you, but we cannot guarantee anything. That's the current pitch that you have. And the pitch that I think a lot of fund managers would be happy with is, okay, we have some fixed costs, I don't know, 50 grand, for example, but then we'd like to earn when you earn. And so we understand how technology works, how legal works, how marketing works. And, we're ready to be kind of your partners there and, enjoy the success, enjoy the benefit, and get the fees from there. And this is not happening right now in retail in Europe. I've seen projects like that in residential, in US, Asia, even in Germany, but I didn't see anything for, high stakes commercial assets such as shopping centers here in Europe yet, at least yet. But I know lots of different teams are working on it. Although we don't want to start that ourselves. That's a separate business to run, really. We'd like to focus on the fund business, and we'd be happy to pay to folks who kind of, solve that problem, and we're ready to work with those folks as a partner. I would be happy to know what Zach's experience there is.
Yeah, I'd be interested.
Yeah, I think
yeah, sorry, Zach, go on.
Well, I was just going to say, I think the tokenization, is fascinating, and I continue to read a lot about it. For us, we're solely investing in multifamily, and here in the U.S., the best type of of conservative long-term loan for multifamily is going to be agency debt, Fannie Mae or Freddie Mac. And so because of that, that really restricts us and I think limits us in our ability to enter into these more innovative token ownership structures.
Simon, I think what Simon, we need to consider as well is Europe and the US are very well-run markets, very well structured, and they have a long history where things are working the way they're supposed to work. Real estate is delivering returns, sometimes lower than other asset classes, but they're stable returns. Now, when we go into other countries and markets where the real estate structure is not as sophisticated as we have it here in the West, this is a environment where tokenization can thrive. If you go somewhere to a third world country where the government is not stable and you cannot rely on the national bank, there you start to think about as a consumer, where can I secure my capital? Do I want to leave it in a bank where inflation is hyper high? Or do I just want to buy some tokens and my returns are steady and the return is coming in? So that's why there are certain clusters in the world, such as in Southeast Asia, in Africa, where tokenization, or even like the Middle East, where tokenization is picking up much faster than in the West. Maxime, you're on
I
mute.
think you're muted.
Yeah, if I can add there, I think, tokenization is not just a matter of, tax planning or confidentiality or risk, as you put it, in third countries, but it also opens up the world, investment world, for people with low tickets. Like if you are in a commercial real estate business of buying shopping centers, in order to get the shopping center, you have to pay, I don't know, 10, 20 million euro. And so funds like ours, we have a cost of LP acquisition. That's why our minimum ticket is in the hundreds, thousands of euro. And we cannot allow ourselves, I mean, the process is quite expensive, and we cannot, bring in LPs that are willing to invest 100 euro, for example, or even 1,000 euro, because our costs to onboard that LP will be higher. But what blockchain and tokenization allows you to do is to substantially decrease those costs if you know how to work around the compliance issues and legal issues. I mean, not around, but just to comply with all of them. Then you are untapping the potential investment pot with people who are now able to enjoy the returns of a shopping center, but with a ticket as low as $500, for example. So, that prospect, that promise is a huge thing by itself, because it right now opens the world of those big assets, heavy in terms of equity requirements. It opens them up to the public, because usually if you are an individual and you have, let's say, I don't know, $1,000 or even $50,000, what you can afford are typically some of the assets that might not yield as well, have limited returns. When you acquire, when you tap into a building business, like I'm sorry, not a building business, a business of owning commercial real estate buildings, you tap into a different world of different debts, debt interests, commercial real estate yields, et cetera, et cetera. And with low tickets, sometimes you just simply cannot get there. And tokenization gives you that right as a small investor. But again, that's a hard topic. At least I found it the hardest in terms of marketing, to make sure how do you as a fund or as an asset manager invest in marketing in a way that provides returns to your limited partners, to your existing fund strategies in terms of returns.
Yeah, let me ask another question to Zach. I think finishing up this conversation about tokenization, in the West, I can go to a bank and buy shares of a REIT.
Right.
In some other countries, the banks do not provide that. So I need to have a different way to access a property in London or the Midwest. And I've heard from a lot of family offices in recent months that multifamily properties in the US might be the underrated performer for 2025. Zach, what do you think about that? Do you think it is that asset class which brings in stability in this kind of market situation?
For tokenization?
In general, real estate, residential.
Oh, do I think multifamily is going to be a good investment for 2025?
Yeah.
Yeah, I do. Well, I do think that select secondary markets are really where you're going to see, attractive risk return, particularly in multifamily. So if you look at cities like Indianapolis, Kansas City, Charlotte, Raleigh, we're seeing positive net migration in as people move for affordability, for job opportunities, for quality of life, and that's really driving up occupancy rates for multifamilies to record highs, especially in these areas. We're seeing like 95% plus occupancy rates. And so if you compare these secondary markets in the Midwest and the Southeast to gateway cities like New York and San Francisco, we're also getting much higher cap rates. We're able to buy the properties at higher cap rates between 5 to 7%. And so the acquisition cost per unit remains significantly lower than in the primary market. So essentially, in these secondary markets, LP investors are getting much more value for their dollar, for their investment, with less exposure to the volatility that we've seen in a lot of these overbuilt primary markets. And these secondary markets have also shown a lot of resiliency to the economic cycles. Um, so in fact, if you look at where the majority of the high tech firms are locating new operations, they tend to be in the Midwest and the Southeast. So, for example, in Charlotte, Ohio, Intel started constructing 2 advanced semiconductor manufacturing facilities with a $20 billion investment. In Kansas City, Google's committed $1 billion for a new data center. In Nashville, Tennessee, Apple's pledged $1 billion for a new engineering hub. In Raleigh, North Carolina, um, um, there are additional tech companies going in. So the Midwest and the Southeast, they're increasingly attracting these large high tech companies, and it's primarily due to the lower cost of coming in, the very attractive governments working with these employers to attract new businesses, the available high tech talent, and a supportive infrastructure. And all of these tens of billions of dollars being invested in these regions ultimately means there's going to be a huge increase in demand for additional housing. So I do think that that area is going to be a bright spot for investors, and we're already seeing it in terms of increasing occupancy and increasing rents.
Thank you for that, Zach. I think technology also plays a role within last mile logistics and grocery anchored centers, right, Maxime?
Yeah.
How do you maneuver around this and utilize the current situation?
Yeah, so first of all, I'd like to say that, what Zach just said is really brilliant. And I think we've arrived at the same conclusion regarding the secondaries market. But, being on different sides of the planet, we didn't talk to each other, but
Yeah.
arrived at the same conclusion at the same time. Well, maybe at different times, but at the same conclusion. That's exactly why we're not doing any primes, because in the secondary market, in second and third tier cities, you kind of enjoy the same type of cash flow. You kind of enjoy the same type of risks, almost the same, in terms of those cash flows, but the cap rates are different. And the answer, the explanation why the cap rates are different is because the liquidity is a bit different. Obviously, you have more liquidity in prime locations and a little bit less liquidity in in secondary locations. But that is very subjective. You know, when you take a look in absolute values of the liquidity that's out there, you still have, you know, I don't know about the US, Zach will probably tell more, but you know, like in Poland or in Spain or in the UK, if you are trying to sell an asset with the in the second or third tier city, all of a sudden you get 30 to 60 potential buyers that are interested in that, might be interested in that particular product that you're selling. And right now, I'm not talking about a single unit apartment. I'm talking about, you know, a commercial real estate building. So obviously in prime locations, you have, you know, probably 3 times the number, maybe more, but still you have some decent pool of potential buyers. And when you have a potential pool, you have more offers, and when you have more offers, you can sell it with a premium and not a discount. Okay, but getting back to the last mile logistics and other trends that you mentioned, I'm happy that you mentioned it because, you know, I hear a lot about it from different limited partners. They are saying, look, you know, what's going to happen with all those different formats? Or sometimes they say, okay, look, Amazon is eating the world. I mean, who's going to need retail? Retail is dying. Retail is no more. And so, you know, statistically, I'm constantly monitoring these things, and you know, just to monitor this thing, you can do a very easy thing. In previous years, it was really difficult. You had to talk to the experts. You have to dig a lot of data. Right now, you just bring in Perplexity on your screen, or just go to ChatGPT or Claude, and you just type in and ask. And you know, if you ask, like the U.S. is the most dynamic market in the world in terms of real estate, for sure. And so if you ask, you know, a commercial real estate consultant such as Knight Frank or CBRE, for example, like what is the volume of gross leasable area that US in retail, for example, that US had in 2020 or 2021 and has now, you'll find that the amount, the volume of the gross leasable space has indeed increased. And then if you ask, like how much of that space is really leased, you will see that the absolute values of the leased space have increased as well. So, you know, that's totally different from retail is dying. It's similar to say that, you know, that banks are dying. Banks are not dying, they're transforming. You see more and more digital banks and you say, okay, that branch that I have over the street is going to be dead. Probably the branch might be dead, but it doesn't necessarily mean that the bank industry will be dead, because they will just simply transform into a new banking business. The same thing applies to retail. Like you all remember, there is, by the way, a very interesting YouTube channel in the US called Dead Malls. I mean, I'm in distress each time I see that, because I mean, it's a lot of investments just evaporated, and I see that, and I understand that, you know, if you are not playing your cards right, you can be next there. But if you take a look at those formats that you see dead, it's mostly about, you know, hyper formats that were very popular like 20 years ago. You went to a supermarket, and it had, you know, 20,000 of square meters of space, and they had all types of different products in there. Now you rarely see that. We are more commonly used to something like 7,000 square meters of GLA, or even 5 or even 3. And so I don't need, you know, 30 or 50 types of milk. I need experience, I need advice, I need recommendation, which milk would be best for me, right? If I'm a skateboarder, I don't need 100 types of skateboards just on the shelves of the store. I need a ramp and do the test. That's what I need.
Can I ask,
right?
sorry to chip in, but
Yeah.
I'm conscious of the time, and here in the UK, it's gone 4 o'clock. and if sadly I'm going to have to sort of wrap it up shortly, but can I ask you a broad question to conclude with, and with a sort of very short, if you don't mind, a response, just to sort of get your view on this, because as I say, this podcast will be up for a long time, and it'd be lovely to see it even in a year's time, if that's not crazy, and see how right or wrong you were then. So would you both say that you are pretty bullish about the outlook for the foreseeable future? We haven't really discussed we touched upon it, we didn't really talk about the Trump slump, tariffs, the possibility of recession, high interest rates potentially staying there for longer than was certainly forecast at the beginning of the year. Certainly, Zach was talking about the really good things that are happening in terms of the demographic changes, the business development, and the population increases, and the demand for property in the US, both, I guess, commercial and residential in different parts of the country. And I would, although you're European focus, Maxim, but you're obviously global in outlook, whether you have the same perspective. So are you, generally speaking, pretty bullish despite the headwinds that we all know that are out there? If you don't mind giving a short answer to that, and then sadly we'll have to wrap it up.
Yeah, the
Sure.
short answer is yes.
Okay, that's very good.
Done. Well, just to put things in context, since this is being recorded, I think here in the US, the Fed acted very quickly in response to the post-pandemic inflation spike. They raised interest rates to a high of 5.25 to 5.5 by July 2023, and that was the highest since 2001. And they had 11 rate increases, an extremely rapid rate increase. And now with inflation starting to cool, they've started to cut. They're currently between 4.25 to 4.5. But right now, as you alluded to, there's some concern about what's going to happen. Trump is in a fight with Jerome Powell, the Fed chair, and Powell's taking this. He's signaling this cautious approach, saying, "Well, I don't know what the long-term impact of tariffs are going to be on inflation." So he's indicating a pause. But I think if you look at over the next 2 years, experts are forecasting a 70 to 80% probability of multiple rate cuts. They're suggesting a total reduction of 1.5% to 2% by mid-2027, and that would bring the Fed fund rate down to a range of 2.25% to 3%. So with respect to multifamily cap rates in the US, I think we're going to see them come down over the next couple of years. And that will be great for investors who can invest in properties that are performing well today and are projected to continue to perform through a 3 to 7 year hold. If investors can get in on an investment like that, they'll be very well positioned for a strong exit as cap rates continue to compress.
Right. Well, I think that's
Okay.
a really good note to
If I
end
can,
on.
if I can a little bit elaborate on my yes, just a couple of sentences, if I may, just to explain the rationale behind it. So, yes is not because we just manage other people's money, limited partners' money, and we experiment on them. Yes is because we manage our own money. Like we have roughly 15% of equity coming in from the general partners. So we kind of betting, and kind of I think that shows the skin in the game that we have there. But I just wanted to underline that we are a value-added fund, and being a value-added fund, you bet on your expertise and knowledge rather than on market macros. I don't intend, or I don't pretend to know what the macros hold for us, what Trump is going to do tomorrow, what tariffs effects will be, what's going to be the interest rates in a year. I don't know that. I can try to use this the scenario approach and try to see what is the most likely scenario, but I wouldn't bet on it. We're betting on our management skills and expertise, because in value added, you can outbid the market even if the wind is blowing in your face. And this is exactly what we're betting on. Especially in turbulent times, you see much more value added assets that you can add to your portfolio. While in the turbulent times, if you are not pressed to sell, you can enjoy the safe harbor that the retail provides.
Great. Thank you both, and very much indeed. Thank you. I guess I'm going to do a future thank you for those who are listening to this in the, as I say, the days, weeks, and months ahead. Hopefully you'll join us again, all of you, for the next one. Oh, and by the way, Zach and Maxim, we're going to be doing real estate investing in the June issue of AIS. We'll very likely take bits and pieces of what you said for that. We'll let you know about how that goes. Have a very good day wherever you are in the world, and hopefully see you all the next time. Goodbye,
Terrific.
everybody.
Everyone, bye.
Bye-bye.